Analysts see Black Monday warning signs in 2025 by comparing today's market to the lead up to the 1987 crash. From the behavior of the US dollar to political pressure on the Federal Reserve, several factors are lining up in a way that has experts on edge. In this video, I'll break down what it means, why it matters, and what investors should watch right now. The article, Trump and the Dollar Are Doing Something We Saw Just Before the October 1987 Stock Market Crash, written by Mark Hulbert in MarketWatch, points out that the US dollar index just had its best week since October 2022. That's after a brutal first half of 2025, where it dropped almost 11%, the worst start since the index began in the early 70s. Now, the dollar's strength or weakness doesn't always predict what stocks will do. Historically, the correlation between dollar moves and S&P 500 earnings is extremely weak. But here's where it gets interesting. In extreme situations, the dollar can be a warning signal. The author draws a parallel to October 1987. Back then, the dollar had been falling and the Reagan administration was actively pressuring the Federal Reserve to cut interest rates. The idea was to boost the economy ahead of the 1988 election. Instead, it triggered fear of a currency war and the Dow Jones collapsed 22.6% in a single day on Black Monday. Today, we're seeing a similar setup. Political pressure on the Fed to cut rates, stocks trading at high valuations, and the risk that a weaker dollar could scare investors. So, what does all that actually mean for you as an investor? The dollar is basically the world's measuring stick for value. When it drops fast, it can shake confidence globally, especially if other countries think the US is deliberately trying to weaken it for political reasons. That can lead to what's called a currency war, where countries devalue their own currencies in response. In 1987, that fear made stocks look too risky too quickly, and selling snowballed into a crash. Today's market is already stretched. Valuations are high and investors are nervous. If the dollar falls sharply while the Fed is being pressured to cut rates, it could be the spark that triggers a sell-off. Today, we also have new concerns. Trump's tariffs on imports from China and Mexico could raise costs, fuel inflation, and pressure the Fed to delay rate cuts. Meanwhile, earnings are mixed. Big tech is doing fine, but small caps and retailers warn of slowing demand. Adding to concerns, the VIX is climbing, signaling that institutional investors are bracing for potential market drops. Now, this doesn't guarantee a 1987-style crash. History doesn't repeat perfectly, but indications are there, so investors need to be mindful. So here's the takeaway. Watch the US dollar, watch the Fed's moves, and watch how global markets respond. If you start seeing headlines about a rapidly falling dollar and political fights over interest rates, pay attention. A sharp drop in the dollar can trigger a chain reaction among foreign investors. What you should do is keep some cash ready for opportunities and avoid overexposure to highly leveraged or speculative positions. If you enjoyed this video, make sure to subscribe and check out my other stock-related videos. Until next time, goodbye.